Hello, everyone. Good evening. Hello, good evening. How are you doing? If you're here, please say hi. How are you all doing? Okay. Hey, everyone. Can you hear me? Can you hear me? Hey, everyone. Can you hear me? Cool. All right. How are you all doing? Hi. Hi, Stan Chooks. Hi. Hello, Bisu. I am busy. Hi, Shala. Hi. Hi, Jennifer. How are you? Hi, Rofiat. How are y'all doing? Hey, Yinka. Welcome. How are you doing? Welcome, everyone. Thank you for being here. How's everything going? Okay. So tonight I'm gonna start to share slides. In the meantime, please introduce yourself and where you're from. We're gonna have a quick one, short and straight to the point. All right, let's get started here. Welcome, everyone. Hello. If you're here, say hello to me, please. Hey, hey, Redmate. I'm trying to. Iembe. Yes. Hi, Iembe. How are you doing? Sorry. Sometimes I try to merge those names. How are you doing, guys? Good evening. How are things going? Okay, cool. Yes, yeah. Hi, Meg. How are you? Okay, I see Meg is on Instagram, and I also see she's on Facebook. Yay! All right, so let's get started here. Please continue to say hi in the comments and also introduce yourself while I go ahead with this. I'm going to use a better. Okay, this is better. Welcome, everyone. How are you doing? As you all know, my name is Yinka Olumorin. I'm a coach on this platform, Acquire Real Estate. And what do we do here? If what you're looking to do is to invest in real estate, buying houses. So if you're looking to do things like lease options, fix and flips, rentals, whether you're thinking long-term rentals or short-term rentals, or you're thinking multifamily, or maybe you're already in the game, or maybe even new constructions, you're at the right place. Okay, so I do this with Dario Lamarin, who is a little bit internet phobic, internet phobic. But he's the other coach on this platform. And yeah, he's a licensed builder, helps us students a lot with anything that has to do with new construction, rehab, repairs, contractors, scope of work, and all that good stuff. I'm happy to be here. I don't take your presence for granted, so thank you for being here. Please introduce yourself in the comments and let's know where you are watching from. Okay, cool. Hi, Ayodeji. Good evening. How are you doing? Good evening, everyone. And as usual, I'm just going to shuffle back and forth between Instagram and Facebook just because I want to be able to interact with you guys. I don't just want to talk. I want to hear you guys also. Is Instagram frozen? Hopefully not. Hopefully not. I see myself frozen on Instagram. Hopefully that's not the case. Okay. So introduce yourselves. Tonight we're going to look into how to go from renting to owning properties. How many of you here are currently renting? Type renting in the comments if you are renting a property that you live in right now. Let's see, have a head count. How many of you guys are renting? Renting, just type renting in the comments if you're renting. Let's make sure this applies to someone. You don't have to be renting, but you could be renting. Good evening, Yim up. Um, Forgive me, but I can't remember the real names on Instagram. If you have a nickname on there, renting. Okay, I see. If you're renting, okay, thank you. Thank you for letting us know. So, yes, absolutely. There is usually a good amount of people renting. I mean, imagine the markets and everything. But there are also other reasons outside of the market, right? So, there is a variety of reasons why this can be. For example, you might have been denied mortgage before. Maybe your income didn't meet the requirements, or you need a bigger home price point for what you're being qualified for. For instance, let's say you need a bigger space that's a certain price point in a certain market, but unfortunately, they're qualifying you for something less than that amount. If you wanted to qualify for a 400K property and your income is only qualifying you for a 300K property, it's a situation, right? So some people are kind of stuck in that, so you're not able to qualify for it, and it makes no sense for a family situation, right? So because of that, you might be stuck renting, and also you might be like confused on what to do, or where to go from here, or even what you need to get results, to move forward, to forge ahead from where you are. So you're at the right place tonight. And if you're renting right now and you think buying a home is out of reach, this is definitely for you. We've had many people make that shift from renting to owning, particularly owning as investors, buying properties that puts money back in your pockets, even when they thought that they could not afford it. Okay. So that's what we're talking about tonight. And we're going to explore a few reasons why people get denied for a traditional regular mortgage. Okay, so reasons why you can get denied for a regular mortgage includes things like you have a low credit score, maybe you have a high debt to income ratio. On the traditional side of things, the debt to income ratio is a big deal, which means that you shouldn't owe more than a certain percentage of the income that comes in. You shouldn't be paying a lot of that income into other expenses, just so they know that you're able to afford to pay that mortgage on a monthly basis. So they kind of see how much debt you have to service, how much debts do you have on your credit card, how much debts, how much loans do you have, and they compare that to how much income you have coming in, and they make that calculation. And if you're above a certain limit, then unfortunately you get denied the mortgage. Okay. Right. And then the other thing is if you had like an unstable employment history, let's say you were going from one job to another, or maybe sometimes in a year you don't have a job, and then you maybe like crashing on jobs, and maybe you have like um, really just short transactional temporary opportunities. So that can definitely affect how much you're qualifying for. And a lot of people are in that situation. So if you're currently renting, it's not your fault. It might just be a lot of different factors happening, right? It might be the high debt to income ratio. I mean, you gotta do what you gotta do. You gotta live your life. Hopefully, if you're not wasteful, then you have to do what you have to do. If you're doing your best, you're doing your best. So I definitely understand. But then there are also things that you get to do. You get to choose to do to get out of that kind of situation where it's just never enough, right? So, and I think that's why most of us are here, where we want to be able to have that opportunity to get out of those kind of situations where it feels like you're held bound and there's no way forward. And that's why this is a very important topic for most people. Okay. The other thing is maybe your income is not sufficient, you're not making enough money, right? So you don't have enough income. If I'm looking down, it's because I'm watching people on Facebook. I'm trying to see the communication. And if I'm looking up, I'm seeing Instagram folks. So bear with me for all that. Okay. So maybe you don't have enough income. You could get denied a mortgage if your income is just too low, right? And then the other thing is they would ask you for, proof of savings, proof of funds. If you don't have that, then it is possible. How many people even have $20,000 saved? How many people even have $10,000 saved? And most markets, for down payments, you definitely need more than those amounts, right? In a lot of markets, you need more than 20K, you need 50K and above for down payments. Not a lot of people have that saved. But the interesting thing about real estate investing is it bypasses all of these requirements, except for an extremely low credit score where you have to go into creative financing. So there's even with that low credit score, there's still a pathway for you to explore other financing out of lenders. But lenders still go really low as far as their requirements on credit score. Usually in the low 600s is where they start from, right? So if you're in the 500s, you definitely got to go into creative financing. If you're in the 600s and up, then you're good to go for the most part, right? So as a real estate investor, you don't care. They don't care about high debt to income ratio. It's not something that they put into consideration because it would be an asset-based lending, an asset-based product, which means they consider the income that property would generate. They don't look at your employment history. They don't even care if you have a job, right? They don't care about your income either, right? They don't care if you're making income, if you have anything going on the income side of things. Also, for down payment, they don't care where you get that from. It doesn't have to be savings. It doesn't have to be, it's not a huge down payment because the down payment you're putting down for on the traditional side of things is a down payment on the total value of the property. On the real estate investing side of things is a down payment on the current purchase price of the property, which is usually a lot lower than a typical. So 10% on the investor side is not the same as 10% on the traditional side. They're very different, right? Okay. Can you tell me if you guys can see stuff on Instagram because it's frozen on my end and I just don't know. It looks like it's just my picture frozen. Can you see like the slide I'm sharing? Can you see the material? If you can say yes, if you can see that, I'd appreciate it. I wonder if it has to do with my internet. But please let me know if you can see that. Just so if I need to reconnect to Instagram, I can do that rather than having you guys go through the pain of having no clue what I'm saying or illustrating. Please let me know if you can see that. Please say yes. Okay. Okay. Meg says they can see it on Facebook. Okay, and she says on Instagram. So thank you for confirming. So let's talk about three frameworks for owning properties as investment. Three frameworks for owning properties. But before using these frameworks, you need to have a mindset shift. You're not only thinking of buying a dream home, you're more concerned about buying an asset. Okay. What is the difference between that, a dream home, and asset? What would you guys say is the difference? What is a dream home? What's an asset? What does one have? What does the other not have? If I'm saying that correctly. What is the difference? You have a dream home, you have an asset. What's the difference? I would like to hear you guys. What do you think? Please type that. What would you say is the difference between a dream home and an asset? What you got? So, what's the difference between a dream home and an asset? Of course, a dream home is where you're looking to live, right? So, you're imagining a lot of good things. What is your dream home looking like? Maybe it has a pool, maybe it has a huge backyard, maybe you have a grand kitchen with an island and expensive utilities. Someone says, Yinka says, dream home is a home you have for yourself. Okay, cool. Maybe it has multiple car garages. When you say dream, right? Let's make that dream come alive. That's a dream home, right? So someone on Instagram says living in and investing. Okay, and if you introduced yourself before and I missed it, I don't think so. So that's okay. Okay, living in and investing. And while you're, telling us, if you don't mind, just telling us what your first name is, so I can address you appropriately. Yes. So the dream, you're making it suit yourself, you're making it suit your family, you're making it look good for yourself. You are not making any income from it. So someone here says assets is a property that is for rent or sell. Good, right? So you're not making any income from a dream home. Whereas an investment property, you are making income from an investment property. So the investment property makes your life better. The dream home can make your life better if all you need is really to be comfortable and you have the means to make that happen. You are able to pay a high mortgage, you're able to just be okay, right? With a dream home and be comfortable paying the taxes and all of that. But an asset, on the other hand, those are properties or is a property that actually pays you back, gives you money, and makes your life better or makes your financial statements look better, right? Gives you a better net worth and also ultimately builds generational wealth. So we gotta have that mindset shift, okay? So for people who are saying, I want to get into real estate investing, but I want to let me first of all buy a home for myself. No, you don't need to buy a home for yourself before you buy an investment property, because I get that question a lot. You don't need to buy a personal home before buying an investment property. Those are two different things. In fact, I was a renter while being a landlord of properties, right? I was still living in a rented condo, even though I was a real estate investor, right? So you don't need to do that. And you don't have to wait till you can purchase your own personal home. So, number one framework here is house hacking technique. And a lot of you guys know what house hacking is, right? So, let's say you apply for a mortgage. Now it would be a regular mortgage. Let's say that you can actually qualify for a regular mortgage, but you also wanted to have that investor piece where you have some money coming in, where you have your net worth improving a little bit, right? So you're buying this 2 units and you're leaving 1 unit and you're renting out this other unit. So you're the landlord on this property, living this property. You rent out this other units. Hopefully, this whatever this renter is paying takes care of the mortgage. If it doesn't take care of the entire mortgage, it will take care of a good chunk of the mortgage, where you can actually see that it makes sense to do this other than buying your own personal home, and you have to come up with an additional more and bigger mortgage expense. So you're doing the numbers and you're trying to see if it makes sense for someone living in here paying a certain amount based on the market rent value. If this is a 2 bedroom and 1 bath, you don't expect to charge this person what's that market charges for 3 bedrooms and 2 bathrooms and use those numbers. You wouldn't get what you're trying to achieve. You won't be able to achieve your goal if you did that. So you're looking at comparable properties in the area and you're making a decision as to what the rent price would be, and you're already getting that mortgage estimate and an amortization from your agent or your mortgage broker, and you're already seeing that, but I can have this rent cover all almost of the mortgage, right? So now you're at an advantage. What does this do for you? It gives you the experience. You can definitely label this property number one for a lender who maybe wants experience to give you a better deal, right? The other thing else for you is your taxes, right? You can claim those mortgage interests on the taxes. You can also depreciate this asset on taxes, so you get depreciation benefits. So tax wise, you're in a better place. Even if cash wise you're not quite there yet, but tax wise you're in a better place. Cash wise, it's very helpful. um, and then the other thing is appreciation. The property value goes up, and over time, it builds that equity as you go. So you're definitely in a better place, but maybe you're not quite there yet. This is typically a traditional mortgage, not an investor mortgage, because an investor mortgage requires it to be non owner occupied. So if it's owner occupied, it would be a traditional mortgage. Okay, so this is a typical house hacking technique where you're looking for a multifamily. It could be 2 units, it could be 3 units, it could be 4 units. As long as the numbers are making sense, as long as you can qualify for that price point, it is a great idea. Actually, the more the number of units, the more likely that you're not going to pay any mortgage and you're going to cash flow even more. So I would say go as high as you can on the number of units and get that cash flow. Okay, cool. So that's framework number one, which a lot of you guys probably already know. Framework number two would be the investment property technique. Okay, the investment property technique. Okay, and if you have any questions, definitely dump those in the comments and I'll look every now and then. Investment property technique. And with the investment property technique, what is happening really here is this lender right here is not a regular typical lender. This lender is an investor lender, is an asset-based lender, and they cover close to 100%. Some of them will cover 100% with experience, but usually for a newbie, they cover pretty close to 100. We've seen around 93%. Really depending on the evaluation, how they see things, and they wanted to go that far. And also depending on the lender. Some lenders will not go. Some lenders probably at 90%. Some lenders will probably at 85%. I definitely don't see a reason why a newbie that's all right as far as being in the right credit score. I mean, the minimum if you're 620 and up, it should be able to put you at, or at least 650 or 660 and up. You should be able to get that at least a minimum of 85% covered. But whatever they choose to cover in that range, as close to 100% as possible, you as a newbie are supplementing. 401k is one of the options you can use. You can diversify your 401k to make up for whatever they choose not to cover, but they cover most and pretty close to 100%. You can use private money lending, and private money lending, you don't need anything. You don't have to have 401k. You just need to use the right techniques to get private money lending, right? And the other thing is lines of credit. So you can build lines of credit on your business lines of credits. You can have a home equity line of credit. If you had a home prior to investing, you could have a home equity line of credit. You could use that. You could also use a personal line of credit. You could use a business line of credit. Then credit cards. Absolutely. You can buy a personal home with a credit card, but you can buy an investment property with a credit card. Okay. So credit cards are a great idea. Personal credit cards are good. However, if you're using your personal credit cards, it's going to affect your score more than likely, except you have very big limits where whatever you're withdrawing out of that credit card would barely affect your score, right? But if you have a smaller limit, there's a high possibility that it's going to affect your credit score. But I'd rather have a temporary drop in my credit score than not do a deal, right? But then you also have business credit cards. They're the best because even if you used up the entire business credit limits, it's not going to affect your personal credit score. As long as your personal credit score is intact, you're good for the most part. If you're trying to improve your credit score, because the better your credit score is, the better deals you get. The better your credit score is, the better terms you get, right? So it makes sense to improve your credit score wherever you are in your credit journey. It makes sense to continue to improve that credit score. And the other thing you can also explore is other loans. So outside of this, you can also have other loans or gap funding to cover whatever small percentage that's left untouched. Okay. And with the investment or investor framework, you're actually going to go ahead and pull funds out of the deal. Okay. So you pull your funds back wherever you were getting this money from, putting it into that property, you got to pull that back out. And lenders will help you do this. You pull that fund back out, maybe with even extra funds, which we call cash out. If you're pulling this fund out, it's not really a cash out. But if you're pulling more than this funds out, then you have that additional amount is a cash out. So you're actually able to do that, pull that fund out and repeat the cycle so that it's really no money out of pocket. You can see we don't have savings listed here because these are money sitting. This is your money sitting in an investment vehicle that might not give you as much of a return on investment as what you're trying to do here. And then these are other people's money that you can use and also recycle. Okay, does that make sense? If that makes sense, that makes sense in the comments. Let me know that you're following this framework. Makes sense? Makes sense? Any questions on that? Does that make sense so far? Okay, cool. So we're going to move on to the next framework, which is framework number 3. And we call framework number 3 twofold boon. And I have to say, this is something no one teaches you, really. This is something I learned by experience. This is something no one teaches you. It's called the twofold boon, and it provides benefits in 2 different ways. Okay, so let's say we're going to first of all use the investment property technique. Let's say you're brand new in real estate investing, but you also need a personal home. You need both. You want to be able to satisfy that investment property criteria and also personal property criteria. But maybe you don't want to come up with that entire down payment. Maybe you're not qualifying for a mortgage on the traditional side of things. You're only able to qualify for a mortgage on an investment property, but you wanted to be able to buy a personal home or have a personal home as well. So we're able to accomplish both with the twofold loan. Okay, so what happens is you're going to buy this investment property. You're going to follow the same exact thing we did right here. You're going to do this. Okay. But you're going to buy that investment property using the same techniques. You're using your 401k. If you wanted to diversify that 401k, you're using private money lending. You're using business credit card or business lines of credits or HELOCs. You're using other people's money to buy an investment property. Of course, you're not telling the lender right now that, hey, I have the intention of holding this property. We don't know yet for sure, right? But for now, this is an investment property. Okay. So we do that. That money, this property came up without money out of pocket. Okay. So when we're done fixing up this property, which I always advocate for because that's one way to make money. That's one way to be so extremely wealthy in real estate investing. That's one way to gain speed in real estate investing because guess what? If you're not um, putting forced equity into a property by fixing it up, you're going to be paying 20% down. You're going to be paying 25% down. The property is not going to pay you upfront. So that's why I always okay, if you really want to go speed up in real estate investing, you got to be prepared to put some work into a property. You got to start to network with contractors, right? So this is an investment property for now. Okay. So when you're done fixing that property up, usually on the investment side of things, we'll fix up the property and we'll get a renter in there. But in this situation, we're going to fix up the property and we're just going to go ahead and refinance this property. How we're going to do that? So we're going to refinance this property into an owner-occupied property, which means you and your family is going to live there. So what's going to happen is when you're refinancing, you're changing the mortgage from this investor mortgage to a W-2 mortgage, if you qualify at that point, right? A W-2 mortgage. But wait, so the thing right here is it's actually a very different process. And I'm saying if you qualify because you might not be a W 2 earner. You might be like a self employed person, right? So that's what I mean by qualifying. But why would you qualify for a W 2 mortgage here if you weren't able to qualify for a W 2 mortgage upfront? You can qualify for a W 2 mortgage right here because of that work you did on the property. You don't have to bring any money out of pocket. In fact, this property will pay you. If you did a great job negotiating the deal when it needed work, this property is going to give you cash in the bank, even though it's a personal property. Okay. So you can use a W 2 mortgage, you can refinance into that. You're not bringing money to the table or doing a down payment. Or you can do a self-employment mortgage. Let's say you're on and off. You can do self-employment mortgage, and there are two categories of self-employment mortgages. So there's the net income mortgage, where it looks at your net income for the entire year. They're not concerned about what the total amount that came in. They're only concerned about what is your actual net for that year. Okay, so you can use that mortgage, or you can use the gross income mortgage. And this gross income mortgage just looks at what came into your business if you're self-employed. Because I remember also when I started investing as a self-employed person, I was really trying to rack my brain around how this thing would be, what's going to work out. And when I came across bank statement mortgages, that was the end. That made all the difference. So the gross income mortgages are called bank statement mortgages, where they actually look at how much came into your business. Definitely wouldn't qualify for that W 2 because you don't you don't earn W 2. Maybe you're employed, but maybe you had so much deduction, you were in the negative. You deducted every single expense and more. And so your net income doesn't make sense. But you didn't have to pay taxes, and that's a good side. So it looks like you lost money, but you were really trying to not pay tax, right? And that's allowed, it's legal. You used all the codes for a business. If you wanted to do that, you could deduct as many expenses as possible, as long as they qualify. And there basically, I can't think of anything right now that doesn't qualify as a deductible expense if it's something you've used in your business, right? All right. So you have that. If you didn't weren't going to qualify based on how much maybe your business was negative, now you have the option of everything that came in. Maybe you're a millionaire on paper, but you're really negative net. Then you know that this is great, right? So you have the bank statements mortgage. But in this case, they're not really, it's not a strict qualification at all, because you have so much equity into the property is going to pay you back. So the lenders are less concerned, in all honesty. They just really want to switch that loan over to a more long-term loan, because the investor loans are usually short-term, especially when you have to do construction. It's short-term. Okay. So you switch that over. What does that do? This gives you a lot of money. A lot of money. This, you could earn over 100,000 at once, 150,000, depending on what you're doing, right? And I have experience. That's exactly what happened to me. At once, you did not buy this property per se. You got a property that paid you money just because you were able to organize things and get a contractor in there. They did everything, right? So depending on where things are at with the numbers, it could be a lot of money. It could even be a new construction, right? If you're already in that side of the training right now, where we're doing new constructions, teaching new construction, it could be a new construction. Your first home could be one, right? So this personal property pays you upfront, and guess what? It is tax free. That payment, that 100K payment, that 50K payment, whatever it is tax free. Okay, you're not. That's not something you declare as income, because it is not income. Even though it's your money, you could do whatever you want with it, but it's not put into the income brackets. Okay, so this is a big one. Okay, hi Jalivia, how are you? Okay, so I saw where you guys said makes sense. I know Instagram froze for a moment and I just got to see things right now. Okay, cool. So let's go into our resource for the night. We have a resource on renter to owner roadmap. If you want that, definitely type that resource, type resource in the comments, and we're just gonna hang around for Mac to get everybody's response so we don't like leave and then some people are still trying to type. So please go ahead and type resource in the comments if you want that renter to owner roadmap where it breaks down what to do as someone who's looking to go into or move into ownership or buying investment property or buying personal property and all of that good stuff. So type resource in the comments if you wanted that. And right here is also coaching, right? If you wanted to get started doing it the right way and getting guidance as you go, definitely type coaching in the comments and you're going to get all the help you need in implementing all the strategies. If you're still here, again, I'm just going to repeat, type resource in the comments if you need the resource for the night, which is renter to owner roadmap, and then type coaching in the comments if you would like to get started on your real estate investing journey. If you're still here, if you want to say good night to everyone, I'm really big on that. Please say good night to everyone. Say good night to me as well. And I'm just going to check in the comments and just say hi to you guys again, everyone. Okay. Okay, so for those saying resource on Instagram, if you could please look, Meg, and I'm also looking as well. Maybe I'll do screenshots just in case. So let's do that right now. And please say goodnight to everyone. Thank you for doing that. Thank you, Yemba. Hey, Chalivia. Jennifer says for business credits is over 600 still good. For business credits, it's a little different. So when you're trying, if you're talking about business credit cards, you want to go above that. You want to be, if you're at 700, it's better. If you want to go into business credit cards, if you're 700, it's better. If you cannot do business credit cards for that difference, you go back into the other options. But yeah, it does make sense to continue to improve your credit. So good night, everyone. Copy, I'll send a link via DM. Perfect. And I think we are all set with our training for tonight. Thank you all for being here. And I'm going to say, have a great night, everyone. Bye.